So the next section is the risk management, and we have two risks which are associated with finance: exchange rate risk and interest rate risk, or currency risk and interest risk. So let's start with the currency risk today. So mainly when we say exchange rate risk or foreign exchange risk, we have three types of foreign exchange risk. We discuss it today. So when we say the risk, first we need to understand the types of risks. We have three types of exchange rate risk. What these three types? Transaction risk, translation risk, and economic risk. We learn these three risks today, first of all, in the type of currency risk. But before that, we will study about what is the meaning of exchange rate system. We will study reason for currency risk, why the currency risk arises, what the reasons are that. And lastly, we discuss about hedging. You know hedging? What is the meaning of hedging? Hedging is any way, any medium, any approach to avoid the risk. Hedge means approach to avoid or mitigate or reduce the risk. Forex or foreign exchange. We will learn about how to convert currency first of all. So let's say you have one currency and you want to convert into other currency. So what is the way, what's the medium? We'll understand it. Then we will learn about exchange rate system. Normally we have different type of exchange rate system we can observe in this world. We have three of them. We will discuss it today. Why currency fluctuates, the exchange rate fluctuates, the type of exchange rate risk, the three of them, and then the hedging method. To avoid the risk, we have internal hedging method and we have external hedging method. Okay, before going to start, let's first of all start with the types of exchange rate risk. We need to understand what is the exchange rate risk types are. We have three types of exchange rate risk: economic risk, transaction risk, translation risk. Basically, transaction risk is what? When you have transactions, transaction means your financial transactions, you buy something, you sell something, right? But these transactions are not in your home currency. Let's say you are based in the UAE, your company is based in UAE, and you have customers in Canada, right? Or you have customers in India, and they will pay you in their local currency. Possible, right? So then in that case, we need to worry about exchange rate. What's exchange rate? How can we define exchange rate? A rate at which we can exchange two currencies. I mean, let's say I have dirham and I want to convert into rupees, Indian rupees. So what rate is applicable for that? The exchange will provide me, or bank will provide me, it's exchange rate. And we know exchange rate keep on changing. We also discuss that exchange rate will also affect due to demand and supply. So if we are based in Dubai and our customer is based in India, our customer is based in Singapore, so let's say they are going to pay in their home currency, then we have to worry about, right? By the way, we don't need to worry about if we are receiving money today. Let's say today we know what is the exchange rate between Indian rupee and the AED. Today we know what is the rate between the Canadian dollar and the AED. So if we have a customer who based in Canada, if we sell goods today and they pay the money today, so there's no exchange rate risk, right? Exchange rate risk will only arise when the transaction is going to happen today, but the settlement is going to happen in 1 month time. A settlement of the money is going to happen in 2 months time. Then we need to worry about the exchange rate risk. Why? Because we sell the goods today and we agree a price today. Let's say the customer will pay us 100,000 Indian rupee. But the customer will pay this 100,000 Indian rupee in 3 months' time. We don't know what will be the exchange rate in 3 months' time. And if exchange rate moves to the adverse side on the day of the settlement, we might face a loss. This is the transaction risk. Okay, so what is the transaction risk? Transaction risk, if we define that, transaction risk is the risk of an exchange rate changing between the transaction date and the settlement date. You got the point? So we have to face the transaction risk only when we made a transaction in other than our local currency and the transaction date and the settlement date vary. Same applies. Our supplier is based in UK. So we are buying goods from the supplier today, but we will pay in 3 months' time. Again, we have to worry about the exchange rate risk. So exchange rate risk relating to the transaction risk is when you made the transaction in foreign currencies and the settlement is going to happen in the future. Is it clear, right? Number one is transaction risk. That's the only risk we will discuss in detail in FM paper. Then we have translation risk. As the name suggested, translation. This is the risk when you have foreign assets, foreign subsidiaries, foreign assets, or foreign liabilities. And when we are preparing financial statement at the end of the period, and we are translating those foreign assets, and if if exchange rate move adversely, it might impact our financial statements. Okay, let's say we have a business in the UAE, but our main production plant is in China, and our main production plant is in India. So by the end of the day, when we are going to prepare our financial statement, we have to show all the assets in our financial statements, including the assets, including the factory in the India. So by the end of the day, what is the exchange rate? We have to convert that factory asset into our AED. And if on that day exchange rate moves adversely, the asset value may go down. This is the translation risk. Or we have a subsidiary in India and we are preparing the group financial statement. For that reason, what we have to do? We have to translate all the assets and liabilities of Indian subsidiary into dirham first, and then we can do the group financial statement. And in the meantime, if the exchange rate moves to the adverse side, then assets might be understated, decreases, and liabilities might be increases in value. So this is the what? Transaction risk. Sorry, translation risk. Exactly. That's the point I want to raise with you. So translation risk is only associated with the financial statement. You picked the right point. Translation risk is the only risk when you are preparing your financial statement and you have some foreign assets and foreign liabilities. Yeah, once in a year or whenever you are going to prepare financial statement, maybe quarterly. Listed companies mean they have to prepare financial statement on a quarterly basis. So whenever you're going to prepare your financial statement, and if the exchange rates moves to adverse side, it might affect your overall impact. It might impact on your overall profits. Why we not? Sorry. We are not doing consultation every month. Look, some businesses have an internal policy to do it, but legally, I'm speaking about from a legal perspective, listed companies, they have to prepare quarterly financial statement because the stock market rules require them to do so. But legally, is varying from country to country, but legally the companies have to prepare financial statement once in a year. But if you are preparing, maybe your company is preparing financials every month, right? They are doing it for internal sake, for the management sake, for decision making sake, for planning, for budgeting, for controlling, for these reasons. But that was not a mandatory requirement, right? We're talking about the financial statement when you're going to prepare it for the purpose of public, when you're going to make it public. I'm talking about those things. So translation risk, where the reported performance of the overseas subsidiary in home-based currency term is distorted in consolidated financial statement because of the change in exchange rates. Understand the difference between the transaction risk and translation risk. Transaction risk is associated with any transaction: sale, purchase, sale of furniture, sale of property, purchase of property, sale of, or any transaction you made in any currency other than your home currency, and the settlement date is in the future. Then you have to worry about transaction risk. And translation risk is only related to financial statements when you have foreign subsidiary, maybe foreign assets only, right? I mean, you have just production plant in other country, like most countries do that. The Apple, they have production plants in China, I think in India as well, because there it's cheap to manufacture because of the exchange rate over there, the cheap labor available there, right? And many examples we can see here. Most of the multinational companies, their corporate office is in the UAE. Why? Because it's a tax-free zone for them. So businesses do that for different strategic purposes. So in that case, you have to worry about translation risk. And the third of them is economic risk, which is a long-term risk, and we cannot hedge it, by the way. Hedge means reduce it. Yeah, we have a lot of instruments available to handle the transaction risk. We will discuss it today. We have some hedging techniques available to manage the and translation risk as well. But what is economic risk? This is the long-term variation in the exchange rate over the year, right? So what is your home currency today? Compare its rate with any international currency rate. By the way, dollar is the international currency nowadays. So consider what is the exchange rate of your currency, let's say Indian currency, with dollar today, and compare it with 10 years before, right? So you will see that the currency depreciate over the long time. So in the long term, we have an impact on the currency. Okay, to explain the economic risk, let me first of all discuss about few fundamental things which is very important for you to learn. If your currency depreciate, let's say, or if your currency appreciate, what would be the impact of it? Let's say, what would be the impact of your currency fluctuation on your exports and imports? are on your importer and exporter. Let me ask you a question. What will be the impact if your currency depreciate on your exporter and importer? Who will get the benefit from the depreciation of your currency? The other side, they will get the benefit. Let's try to understand it from any currency we can pick. Let's say Indian currency I can pick here. So by the way, what is the rate between the INR to AED today? So look, exchange rate is normally nominated in two different terms. We have two different ways of expressing the exchange rate. Look, this is one exchange rate, which is what? 1 Indian rupee is equal to 0.042 dirham. Or we can do in opposite way. Let me make it 1. So what we can say, 1 dirham is equal to 23.57 Indian rupee. These both are the same thing, isn't it? If I say that 1 dirham is equal to 23.57 Indian rupee, or 1 Indian rupee is equal to 0.042 AED, is the same thing. So these are two different ways. We call them codes to explain the same thing. Okay, so let me write it down here. So if I say here, okay, if I say here 0.042 AED per INR. INR means Indian rupee. This is one thing. Our second way is 23.57. These both are the same things. These both are the same things. It's opposite to each other. So one of these quote is called direct quote, and the other of them is called indirect quote. A direct quote is a quote where your home currency is on the nominator side. Look, by the way, here in this exchange rate, we have two currencies. One currency is on the nominator on the top, and the other currency is on the denominator side. So which currency you can see here is in the nominator side? Which currency is on the nominator side? INR. Because look, what we say, 23.57 INR is equal to AED. AED means 1 AED. Look, denominator we always express in one term. So look, in a currency exchange, we always have two currencies. Okay, so we can write in many ways. Look, I can write in this way. 23.57 INR. Okay, this is equal to 1 AED. Is that it means, right? Or we can express like this as well in ratio term. It's same meaning. So what that mean? 1 dirham is equal to 23.57. I mean, if you go to any exchange today, if you give them 1 dirham and you ask them for INR, they will give you 23.57 INR in response. Okay. Or we can express in that way. Same thing, divided by. So we have many ways of expressing it. So what it basically means, we have a ratio here, which means we have a currency on nominator side. Look, this is a nominator currency, and this is the denominator currency. And keep in mind, when we have an exchange rate, the denominator currency is always in one term, always. Okay, or we can call it first currency and the second currency, same thing. So second currency is always in one term, always. There's a rule, basic rule, fundamental rule we need to understand. Okay, so here we would say that our first currency is INR. The first currency is also a variable currency. You can say that. There's a variable currency and there's a fixed currency that we use as a parameter here. Okay, so that's the one way of expressing it. The second way of expressing it is this thing, okay, which is what? 0.042 dirhams is equal to 1 INR. So if you bring 1 INR, if you bring 1 rupee, Indian rupee to exchange, so in response, how much they will give you? Just 0.042 dirham, or you can say 4 fills only, right? In this case, you will get from the stock market, sorry, from the exchange market, I mean to say. Okay, so the first thing is you need to understand the exchange rate is given in two different forms. Now, let's understand the first key point here, and then I will come back to economic risk. What is the first key point? How to convert currency? I mean, what's the way to convert currency? Okay, let's say this is the exchange rate today. Okay, so and today's date is 1st February, 1st February 2025, and that's the exchange rate today. And you are going to sell goods to an Indian customer today, let's say, and customer is going to pay you today as well. Let's make it simple. But customer will pay you in INR. Let's say customer is going to pay you how much? The customer is going to pay you 100,000 INR for the goods that you sell. Now, question is, these are my exchange rate. I can use any of this quote. In exam, he might give you any of the quote. So the question is, what should I do? Should I multiply this with the INR to get the dirham, or should I divide? What do you think? Let's talk about the first thing. This is the rate. Now, should I multiply this exchange rate with this INR to get answer in dirham or divide? Yeah, multiply. So we have a different ways to explain this idea, but I will explain you in very easiest way. Look, understand, it's like a mathematics. Okay, if you said multiply, okay, let's say my rate is this. If I multiply with this rate, what is the rate? 0.042. 0.042. And don't forget to mention this first currency, second currency. What's the currency? AED over INR. So AED over INR, right? Is that mean? This is the rate. So if I multiply, INR will cancel with INR and my answer will be in dirham. So see, if I multiply whether the currency we will get in the EED or not, right? If we find the answer in AED, yes, this is a multiplication case. So in that case, we have to multiply. And by the way, what answer we get? 4,200 only, right? Okay, so yeah, the answer will be 4,200 dirham. But if it was in this case, then what should we do? Let's try that. So if my exchange rate is given in this way, and same thing, if I have to receive 100,000 INR, I cannot multiply, because if I multiply this now, 23.57 INR over AED, you see, INR will become INR square, and there's no way to cancel it out. So what should we do? We should divide it. Look, so when we divide it, which is 1 over, or I can say that, okay, let me write here, 1 over 23.57 57 INR over AED. And look here, INR will cancel with INR. Okay. And you'd say AED is here. So what we have to do, we have to multiply AED here as well and divide with AED here as well. So finally, we will get answer in AED. The mathematics, the basic mathematics, I hope you cover. So what conclusion I want to draw here? What is the easiest way to explain this thing here? So see, if the currency that you are going to translate, whether you're receiving this currency or paying this currency, if the exchange rate which is given to you, see what is the first currency of this exchange rate? What is the first currency here in exchange rate? What's the first currency here? AED. If the first currency is different than the currency that you want to translate, it's a multiplication case, always. Or if the first currency of the exchange rate is the same that the currency you want to translate, we have a division case. You see here, what is the first currency here? INR. What currency we have? INR. If first currency is the same as the currency you have, it is a division case. That is the easiest way to understand that. So, first thing in the exam, whenever you are going to translate any currency into any second currency, see whether it is a division case or it is a multiplication case. Understand? Clear, right? Napura, clear? Did I pronounce well, right? Your name? Nopura. Now, let's understand this fact. So the first point we understand that we need to first see, the first point that we need to raise, that whether to translate the currency, should we have to divide or should we have to multiply? Okay. Normally, look, in the UAE, we follow this rate. Okay. So I will just stick to this rate only. Let's say now this is the exchange rate today, right? This is the 2-day exchange rate, which is on 1st Feb 2025. And the exchange rate, let's say 3 months later, 3 months later, exchange rate, let's say, varies. Three months later, let's say, exchange rate varies to, let's say, 22.560, okay, INR per 1 AED. So what you can understand from here? Which currency depreciate? INR depreciate here? Hmm? Yes. Yeah, Darren. Which currency depreciate here? AED depreciate here. Okay, look. AED depreciate. Look, Indian rupee gets stronger. Okay. Today, if you have 1 dirham, okay, let me explain in the easiest way. And if you go to exchange, so with 1 dirham, giving 1 dirham, exchange will give you 23.57 rupees. After 3 months, with the same 1 dirham, they are giving you less Indian rupee. What that mean? That means Indian currency appreciate its value and dirham depreciate its value, right? Normally, in indirect code, this is going to happen. Okay, what is indirect code? Direct code, you don't need to understand that because I will explain you this idea in easiest way. Okay. So here, but you need to understand which currency depreciate and which currency appreciate. Now let me give you an idea. Let's say we sell goods to an Indian customer. We are based in Dubai. So our currency depreciate, right? Our currency depreciate. We sell goods to an Indian customer today for 100,000 rupee. The customer have to pay us 100,000 rupee. So today, if we receive 100,000 rupee today, so 100,000 rupee divided by 23.57. If we receive money today from the Indian customer, how much dirham we are going to get? 4242 dirham we are going to get. If we receive after 3 months, 22.60, I would receive more dirham now. Why? Because my currency depreciate. So keep in mind, whenever your currency depreciate, exporter will get benefit from it. Look, I was the exporter. I sell goods to the Indian customer. Okay, my currency depreciate, dirham depreciate, or opposite, rupee appreciate, same thing. Because my currency depreciate, I get the benefit from it. I have to receive 4242 dirham, but no, I am receiving 4424 dirham. So that's the key point. You need to note it down. Whenever your currency depreciate, exporter will get benefit from it. That is why the economies who are the major exporter in this world, they try to depreciate their currency, like China. Which economy has the lower exchange rate? Are their exchange rate depreciated? Their exporter will get more advantage as compared to those economies whose exchange rate appreciate its value. Got the point? And let's look at the impact of it on an importer. Same example, let's say now we buy goods from an Indian supplier today. If we pay today, how much we have to pay? 4242 dirham. And if we pay in 3 months' time, how much I have to pay? I have to pay more. So what that mean? Importer always want that my currency would appreciate. And exporter always want that my currency will depreciate. Because if my currency will depreciate, I will get more benefit. I can reduce my prices than the other exporters who are based in other countries. But still I will get my profit. They are not able to get the profit because their currency is not as depreciated as my currency. Right? So that's the phenomena you have to understand first. So now let me relate this to the economic risk. Let me relate this with the economic risk. If you bring your investment in the other economy, like Apple or any other business, if they brought up their business in Pakistan, in India, okay, of course they have to bring dollars in India and convert into Indian rupee, because in India it's only possible to do trade in Indian rupee. And why you bring? Because of course you will bring remittance from the India to UK, whatever you base on. And what happened? If currency keep on depreciating there, right? You are kind of an importer there now because you bring business there. So what will happen? Okay, you maybe get profit because currency is getting weaker and weaker. In the longer run, you are getting advantage. But when you bring the money back home, because exchange rate is too much affected, and you are not going to get any real return. That is the economic risk. And this is a risk that arises over the years. There's no one who is going to hedge it. Look, by the way, how can we do hedging? Normally we do hedging using the banks. There are a lot of banks or exchanges who give you hedging instruments. Who will give you hedging for 10 years? No. Hedging instruments are only maximum for 1 year, 6 months, 9 months, 6 months, 3 months. Yeah, there's one way to hedge the economic risk: diversification. So if you are a British company and if you all of your business subsidiary, let's say you have one subsidiary only in India, so you are more exposed to economic risk because your total business is based in India. But on the other side, if your business is spread across India, Pakistan, UAE, Saudi, Oman, everywhere around, right? Then you diversified your investment, right? Diversification will reduce your overall risk. So there's only one way to avoid the economic risk: diversification, or not bringing investment in those economies where exchange risk is at high. Got the point? So we have three risks now that we discuss in detail: transaction risk, translation risk, and economic risk. Any question about these three risks? I hope it's pretty much clear to you now. And we also discussed that if exchange rate fluctuates, if it's depreciate, if our home currency depreciate, exporter will get the benefit from it. Or if foreign currency appreciate, again same thing. Is the vice versa scenario. Okay.
What is the hedge for the translation risk and transaction risk?
Hedge. Hedge. Yeah, I'm coming to. We're going to. There are a lot of hedging method. Let me show you. These are hedging methods we discussed today. We have internal hedging method available and we have external hedging method available. The topic for today. But let me first of all discuss the fundamental points here. Okay, so first point we raise that how you will translate your currency. Sometime you have to divide, sometime you have to multiply. But now we have another challenge. What? Other challenge is, sorry, when you go to the exchange, let's say if you go to exchange anywhere in the UAE and you ask them, okay, what is the exchange rate today? Okay, so they will ask you first of all one question. Okay, you want to sell currency, you want to buy currency, right? Because when you sell currency, they will offer you a different rate. And when you buy currency, they will offer you a different rate. So there's always a two rate. There's always a two rate. One is the selling rate and one is the buying rate. Let's say this is the Indian rupee versus dollar. Let's say these are two rates available. Again, we have two quotes. This is the same thing. One rate is 103 and 104. We have two rates available. One is the buying rate, the bank will buy at this rate, and one is the selling rate. The bank will sell at this rate. The difference between these two rates is the bank margin. Look, why exchange rate exists? They want to make their profit. Okay, so they will buy at low price and sell at high price, and the difference between these two prices is their risk-free margin. That's why they exist. That's why they're doing trade. So this is called spread or margin. Now the second challenge, okay, first challenge we understand. Should we have to divide the rate or should we have to multiply the rate? Once we understand that, now which rate we have to pick? Okay, should we have to take 103 or 104? Let me see what's the rate right now between the INR to dollar. $86.54. Let's say 86.54. We have the rate. Let me write down here. 86.54. This is INR over dollar. Okay, we can write like this as well, or we can write like this as well. INR 86.54 per dollar. Same meaning, by the way. I just keep INR first or down. Okay, okay. This is my exchange rate today. But let's say bank is saying we have two rates. Okay, we have rates. So we have always two rates. First, always the lower rate presented, and then the higher rate is presented after that, which is, let's say, 88.94. No, we have these two rates available. In the exam, maybe in some question he will give you one rate, then we have no confusion. We simply rate this one rate. But in most of the cases, he will give you two rates. So which race to pick? Very easy question, very easy answer. Look, always remember, as I said, why bank have two rates? Because bank want to earn its profit. So you have to consider yourself always in adverse case. I mean, let's say if you want to buy currency from the bank or from the exchange, or if you want to sell currency from the exchange, be ready for the adverse rate for you. So always consider yourself in adverse case. Always consider yourself in the adverse case in the exam. Like what? You want to sell, right? So we have two cases. Either you are going to sell currency, sell foreign currency, or you're going to buy foreign currency, right? Why you want to sell? Because you receive, you are in the Dubai, you receive Indian rupee, you want to sell. You receive Canadian dollar, you want to sell. You receive Australian dollar, you want to sell. So if you want to sell currency, bank will give you adverse rate. Which is adverse? The rate that result into less receipt. So keep in mind, whenever you have receipt, we have to use the rate which result into less receipts. And when it's a payment, we use the rate that results into higher payment. That is the easiest method to find this thing. Let's practice it. Let's say now here, this is exchange rate, and okay, we are, let's say, based in India here in this case, because we have no dirham here, we have INR and dollar. We are based in India, and we have to pay 100,000 Indian rupee. We have to pay 100,000 Indian rupee here. So first of all, see, it's a division case or a multiplication case? Division case, yes, because the currency that I have and the first currency here is same. When it's same, it's a division case. If you multiply, then it will become INR square, right? So first of all, I understand I have a division case. Okay, now let's divide with both. If I divide with the first rate, 100,000 divided by 86.54, I will get that much dollar, right? And if I divide with second, 100,000 divided with 88.94, I will get that much dollar. Now, keep in mind, we are based in India and we have to make a dollar payment. Okay, we are going to make a payment, let's say. So consider yourself in adverse scenario. So you have to pay which of them? You have to pay more. You have to pay more. So use a rate that result into more payment. You're in adverse case. So bank will buy from you at this dollar, right? And they will sell at higher to make a payment, to make their profit. So always consider yourself in adverse scenario. Okay, so I have to pay this much money to bank, but if I want to sell, I will receive only this much money from the bank. So in that case, what is the understanding? Keep in mind, here we have a division case. If we have receipt, we need lower receipt. So what we have to do? Divide with the higher rate to get the lower receipt. Okay, look, which of this rate is higher? Always second rate is higher. Okay, we are going to receive foreign currency. So divide with the rate that result into lesser receipt, right? And look, always remember, this is a rule. In case of division, in your exam, 99% of the case are division case. Because in UK, they are using indirect codes. 99% of your case will be division. There may be a multiplication case as well. So in case of a division, if you are going to sell foreign currency, so it means same. Export mean you sell. Export, what export mean? You sell goods and you receive foreign currency. So you have to sell foreign currency. Or you have a gain in foreign currency, or you have an income in foreign currency, you have to sell. So gain, export, income, same mean, you have to sell. So whenever you have to sell, we have to divide with a high rate, because when you divide with a high rate, you will get low receipt. And when it is a payment case, divide with a low rate, because when you divide with a low number, you will get more amount, more payment. Okay, let's practice it. Let's practice it with the help of some example. This is very important and fundamental thing. Can you please find the answer for the first example here? Here's the example. Let's say we want to sell. We are based in UK. Let's say we want to sell $50,000. We make our export and we receive $50,000. We want to sell and we need to find answer in pounds. So what should we do? First of all, division case, multiplication case, and then what we should do? Yeah, we divide, because first currency and the currency that we have to exchange are same. So division case. Look, here, what's the first currency? Dollar. And what currency we have? Dollar. Same. So division case. So we divide with, look, receipt. We want lesser receipt. We always consider ourselves as adverse case. We need lesser receipt. So we divide with higher to get lesser receipt. So 1.4130. That is the pounds we will get. Nabura? Okay, second. Yeah, it's a division case again. It's a payment. So payment, use a rate that will increase your payment. You need to see yourself in adverse. You have to pay more, you have to receive less. So you will use the rate. It's a division case. 90,000. Use a rate that will result into decrease in payment or increase in payment. Increase in payment. Use the lower rate. 1.2012 euro. Clear? Darren? Okay, next. Third case. The division case again. We need answer in dollars. Let's multiply. Yeah. This is a division case. Look, see, don't see you're in home currency or in foreign currency. Forget about this thing. See, we have two currencies, right? And we want to exchange. First of all, we need answer in dollar, right? Or look, what is the exchange rate you have? Exchange rate, what is the first currency in the exchange rate? And what is the first currency in exchange rate? ACCA. And what is our currency? ACCA. So it's a division case. It's a division case. Now you want to sell. You're an exporter. So divide with the rate that result into less receipt. Which is which one? Higher. Simple. Higher. We're going to use the higher rate. So what is the higher rate here? We have 40,000 SEK. Divide with the higher one. Look, if you are confused in the exam, try both. Try both and see, we are exporter. We want lesser, right? Use lesser of the amount. If we are an importer, we need to pay more. We want more. So you can try both. By the way, if you are confused in the exam scenario, right? This is the way you need to practice that. So here we are an exporter, we are going to sell, we will get less dollars, by the way, in that case, because we are selling the foreign currency here. So we will divide with that result into lesser amount. Because if you divide with 6.8, you will get more amount. Next, we need answer in dollars again. Again, division case. Your exam will 99% division case. Right? There may be some question you have a multiplication case, but keep it in mind. Okay, so we will divide. Okay, so use a rate that result into more payment or less payment? More, because the buy mean you're buying something, you're importing something, you're going to pay in dollars, right? So we need to pay more dollars. Divide with lesser rate. So 40,000 divided by 3.67. This is the amount. And last two questions. Yeah, division rate, division, and divide with yeah, why? Because we have an import or we have export. It's a receipt. So result into less receipt. First rate 1.3912. Last. No, we divide with the low rate, right? That result into high receipt, right? We want low receipt. Sorry. Look, when we are receiving, what is the adverse case? We receive less, right? It's a receipt case, right? So we want to receive less. So we will divide with a higher rate. You also confuses me, huh? And the last one. Division case. We want to pay more, it's a payment. So divide by the lower rate. So that is the rule. Keep in mind, in case of a division, when you have a payment, divide with a low rate so that your payment will be more. And whenever you have a receipt, divide with low rate, divide with high rate so that your receipt will be less. So here is a division case and we have a payment. So we divide with the low rate so that we will get worse payment, which is this. Okay. Now, let's practice some questions from the 1FM book. Okay, can we solve this question? A and B, both cases? Yeah. Mm-hmm. Mm-hmm. Okay, a UK exporter receive a payment from a Danish customer. So it's a receipt of kroners from your Danish customer. So how much receipts you have? 150,000 kroners. And I think that is the rate, the first one, Danish kroners over pound. So kroner is the first currency here and also kroners is first here. So it's a division case, right? So we have to divide, but which rate we have to pick? Because it's a payment, it's a receipt. It's a receipt. So we want less receipt. So we divide with the higher rate. Okay. So how we will get it? Yeah. So for the first, we have to do division here. So, and we will divide with the high rate here. So 150,000 kroners. Okay, better write currency as well in this case so that you don't make mistake. Okay. Once again, when I erase it, this is going to happen. Okay. I don't know what's the problem, but okay. We have a division case here. We have a division case here. And we divide with the which rate? It's receipt, we divide with the high rate. So second rate is always the high rate. And in second case, we have the import. So we have to make a payment. Again, we have a division case. So 1 million yen we have to divide. So we have to increase the payment. So we will divide with a lower rate so that our payment will increase. So see, this is the answer. Okay, so which rate we use in first case? The same rate. And which rate we use in second case? The same rate. So you need to practice this, right? Let's do one more question. Okay, let's try this. So you buy goods in a currency called reds, and you buy at 100,000 reds, and your exchange rate is, sorry, is this per $1. Division case, right? Because first currency here is reds. So we divide with the, it's a payment, right? So we have to increase the payment. So we divide with the low rate, yes. So 3.35, sorry, 3.5, 3.5650. So when you do that, okay, your answer will be in pounds. So how much pounds we have to find? I mean, at what pound we bought this? 28,050. And then you sell for how much? So what profit you make, you can find very easily. Okay. So in first case, yeah. So you bought at this price, at cost, you sell at this price, and this is a profit. No. What about the second and second case, B case? What if the spot, look, what is spot rate? Spot rate means 2 days exchange rate. The today's exchange rate, we call it spot rate. We have two types of it, spot rate, forward rate. Forward rate is a future rate, I mean the rate after 3 months. The banks always provided you. I mean, what if the rate, if you want to trade in future, 3 month, 1 month, 2 month, 6 month, 9 month, this is forward rate, right? But today's rate is spot rate. Any future rate is forward rate. Okay. So in second case, okay, what if exchange rate is not this and this, what should we do? Same thing, right? Divide with low rate. We will pick this rate, we will pick this rate and see which profit and loss we have. That's it. Same rule we have to follow. See? So in second case, we used to find the low rate again and see. In second case, we make a loss. In third case, we will make a more profit. So now we completed our this topic. We understand now how to convert currency. So the first thing that we learn now, how to convert currency, and second thing we learn now is type of exchange rate system. Okay, now let's talk about two more things very quickly and then we make a break, and after break we will start with the hedging methods. Exchange rate system. How this system works, like how we would say that exchange rate between Indian rupee and dollar is always this, or currently let's say the exchange rate is this, right? And you see the variation, this one, you see the variation in exchange rate that happen over the time. Okay, you see its decrease happen this year from January till June, till Jan, right? So it's Jan till Jan. Okay, it's Jan till Jan. I mean, 1 year fluctuation has happened. Okay, so first of all, let's understand this. What kind of a system exists? Is there any system exists between the countries to manage the exchange rate, or it's not? Yeah, in some cases, in some countries, yes, they have a system exists. Like maybe you know or not, the dirham versus dollar, the rate is fixed, right? The dirham dollar rate is pegged. Pegged means fixed, 3.67. And for many, many years, there's a system that exists that the UAE government take initiative and they pegged the rate, the dollar, right? So normally we have three types of systems that exist in this world. We have three types of system that exist in this world. One is fixed exchange rate. As I give you example in the UAE case, what is the fixed exchange rate? When one currency is always fixed against another major currency, this is called fixed exchange rate. Yeah, will not go up. I think no, it will remain same for many, many, many years, depends on the agreements, right? So I think there are a lot of currencies in the world right now, I think Turkish lira as well, and a lot of other currencies which are pegged, which are fixed against dollars. Why the UAE government take this initiative? Because they want to gain the confidence of the foreign investors, right? If you're a foreign investor and you want to bring money here, so you don't need to worry about. You're bringing money today, of course, you're bringing dollars here and you will convert into dirham. After 20 years, when you are leaving, you don't need to worry about any fluctuation in exchange rate. You will find the same rate, you convert, and you can bring your investment from the UAE anywhere else. So definitely, when your rate is pegged, fixed, so what will happen? Uh, it will definitely lead to the high confidence of the investor. But definitely, this is not a joke to managing your exchange rate at one fixed amount. The government has to take initiative. They have to take steps. They have to play with the numbers, with their policies, their monetary policies, their fiscal policies to, to maintain the demand and supply at the same level and to manage the currency at the same rate. So definitely it results into high monitoring costs from the central bank. Yeah, but that definitely exists in this world. Google it, you will find a lot of currencies in the world which are pegged against dollar. Number one. Number two types of system that is mostly in exists in this world is the floating exchange. Sorry, not this. It's basically managed exchange rate. But okay, let me discuss about the floating exchange rate. Floating exchange rate mean don't do any initiative for the currency. Let's leave it on the demand and supply forces. So some economies, they don't want to play with the rate. Okay, let's leave it. And of course, currency will fluctuate based on demand and supply. So currency is freely trading against other currencies fluctuating with market forces. So government, a central bank, do not need to monitor it. They do not need to spend any money on it, monitoring. The problem is high uncertainty, right? Because investor knew that the government is not taking any initiative as well. Anything might have happened. And if exchange rate move to the very adverse side, we might lose. Look, why I'm saying adverse? Because adverse is different from an importer perspective and the exporter perspective. Okay, maybe it is adverse from one party, it will be favorable for the party. So that's why I always use a general word that if exchange rate moves to adverse side. So if exchange rate moves to adverse side, the government is not backing it. The government is not monitoring it. So definitely the confidence level will be shaking here. And the 90% case that different economies follow a method is called managed exchange rate. What the government do here, the central bank do here, they set a range of exchange rate movement. I mean, let's say, as I discussed here, that the exchange rate between the Indian currency and USD is, let's say, 86 today. Let's say the Indian central bank, they set a range that we will stick our exchange rate between 80 to 90. Okay, let's say the central bank of the India, they set a range of this. So what the central bank will do? Central bank will not do any initiative if the currency rate moves between 80 and 90. But when it try to cross 90, the central bank will play using their policies and try to move it back within the range. So here, you don't need to monitor all the time. You don't need to check, you don't need to change it. You don't need to fix it. Like in the first case, all the time. Okay, let it fluctuate within the range, but only when it's trying to cross the range, then the central bank will intervene and will bring it once again into the range again. That is the mostly exchange rate system that most of the economies in this world follows because it's cheaper. It's not like the fixed one, which is very difficult to manage. Any question? Have a low monitoring cost, and of course, you have less uncertainty as compared to floating exchange rate. Right? We also call this dirty float. The managed exchange rate is called dirty float because you just try to manage it, right? Um, Floating exchange system, this is called clean float. We also call it, maybe he will ask you in the exam in multiple choice, clean float. And this is the dirty float. Okay, these are the three exchange rate system we have. Okay, last, how currency fluctuate. By the way, we discuss about this. Why currency fluctuates? Why exchange rate fluctuates? Because of demand and supply. Okay, demand and supply is the reason, but behind Behind demand and supply, we have many factors. Okay, let me rephrase my words again. Demand and supply are the reason behind fluctuating the exchange rate. But demand and supply will be affected because of many, many factors like inflation, like interest rates of the different economies, like confidence level of the investors on your currencies, right? um, like stability in the economy, like foreign direct investments coming into your country or not, right? A country economy, if the country, look, all of this, by the way, are directly related to your economical condition of your economy. I mean, what is the economic condition in your country? So if your economy is moving to good direction, then people definitely will be more confident. How the, and again, legal condition of the country as well, right? So if a foreign investor brings money into your economy, they need to feel, feel safer, first of all, that their money will be safeguarded, their investment will be safeguarded, right? No one will steal your money, right? Like, why foreign investor trust in UAE? They bring money in the UAE because they have confidence on the UAE economy. They have a confidence on the UAE legal system, right? And because of this pegged rate between the dirham and dollar, the foreign investor, they they have a lot of confidence and they bring money in the UAE economy. So the prime reason behind the fluctuation of the exchange rate is demand and supply, but demand and supply will be impacted with many, many, many factors like inflation, like taxation, like inflation, like interest, like public perception, like speculations, and many other factors. Okay, and then lastly, the last topic in this chapter is hedging methods. Okay, so let's do a break for 15 to 20 minutes. And then after that, so we have 3:30 around, so around 3:45, right? We will start our session again and we will start dealing with the hedging methods.